Welcome to the Market Huddle Plus, where we get a previous guest back on the show. I'm Kevin Muir, and this week we have the good fortune to be joined by Russell Clark, author of The Capital Flows and Asset Markets. Russell, thanks for coming on.
My pleasure. It's great to be back.
Yeah, I have a little bit of a bone to pick with you, Russell. You started doing these terrific audio segments on your Substack, and I found myself loving them so much. And I was like, oh, geez, you know what? I would go and I'd be like, oh, I'm going to go listen to Russell again. And I thought to myself, I actually better do that as well, because I was like, I had to copy you. It's just, you do a terrific job on your Substack. What brought that about? Like, what kind of, what inspired you to make these weekly audio pieces?
It's just I found markets like really weird. Probably since about 2016. Like there were some things that used to stay the same as they've always been, and then other things where the relationship is sort of completely broken down. And so I just sort of was curious, trying to understand why markets had changed so much. And I just find I find it's easier if I sort of talk into the void. If that makes sense.
You do a terrific job. Like literally, and I highly encourage anyone that hasn't gone and checked your Substack, go check it out, because you make these audios that are audio kind of segments that are really entertaining, and I love them. And what I'm going to do for you right now, though, is I'm actually going to play something that was the topic of one of your recent audio clips, and then we're going to talk about it. And you referenced a movie, and so I'll see if you can recognize this.
You snotty little bastard.
Your Honor, I'd like to ask for a recess.
I'd like an answer to the question, Judge.
The court will wait for an answer.
Lieutenant Kendrick ordered the code red, didn't he? Because that's what you told Lieutenant Kendrick to do.
Object!
And when it went bad, you cut these guys loose.
Your Honor,
You
Counsel, I'll
Marcus
hold you in
inside a bony
contempt.
transport.
Your Honor.
You doctored the logbook. You coerced the document.
Consider yourself in contempt.
Colonel Jessup, did you order the code red?
You don't have to answer that question.
I'll answer the question. You want answers? I think I'm entitled. You want answers? I want the truth. You can't handle the truth.
So, Russell, that was a great piece that you wrote recently, and it was about the fact that a lot of fund managers can't handle the truth. What were you going for there? Maybe you could give us a synopsis of your piece.
I think I love that movie so much. It always makes me laugh as well of it. But look, it's I think it's one of these things in like fund management and finance and life in general, that if you're quite successful like in your 30s or 40s, and then the world changes, it becomes very hard for you to accept this new world. And what I was trying to say is that the market price is the truth, if that makes sense. And what you often find is when people will say, well, no, the price is wrong. And when I hear that, what I hear is, well, you don't accept the truth, which is that the market is saying what this is. And that's, I think that's really, it's one of those things that whenever I see it, I try and think about how I can make money from it. And like, for example, the example I always think of is like in the 90s, sort of late 90s, when I first started getting interested in finance. Stephen Roach, I think, was like head of strategy in Asia. And he wrote a note saying 10-year JGBs at 4% was the greatest short ever known to finance. Do you remember that? Yeah, I don't know. But,
at 4%.
At 4%.
Just a little early.
And so many hedge funds blew up shorting JGBs.
Right.
And this is the incredible thing is like, one of the big trades I did do correctly was, after sort of Euro crisis, I basically went, a lot of these bonds and a lot of sovereign debt's just buys. You should just be buying it. I bought a lot of Irish debt. I was just saying, look, the spread from like Irish debt to JGBs is so wide, and Ireland is not going to be allowed to go to default. It's a small nation. It's got the UK, it's got the US, it's got Germany, it's got the EU all on its side. And actually, the policies we're adopting now after the financial crisis are so much like what Japan did. I think the chances are that bond yields just go lower and lower and lower. And, unbelievably for until I'd say 2020, you could still find people who were always bearish bonds. I think then COVID basically destroyed the whole bond bear story. And now, where I'm seeing now is they're saying, well, look, the world's changed. I think bonds are a short now. and they're trading like a short, and they keep selling off and they keep being weak. And yet I keep getting people saying, oh no, we're going back to deflation, bond yields, and now everyone wants to buy, treasuries at 4% when they wanted to short them not that long ago at high yield. I just find it funny. And that was the point I was trying to get across, is that, the world changes and the markets are there to tell you the truth, but it's just some people can't handle the truth. They can't handle a different world, and they don't want to accept what that means.
A couple of things. First of all, one of the things that you mentioned is that often it's the kind of middle-aged managers that get into the most trouble, and the young people are kind of too naive to know and to fight the tape, and then the really old guys are like too smart to fight the tape. And it's Correct. Those kind of middle ones. And I might contend that it's often those middle ones that have had success in one area, and then they want to replicate that success time and time again.
I think it's more, and this is always when I used to short sell. It's something I used to look at for a lot. It's when a fund manager or a certain area of finance, basically their personality becomes a success or a certain type of investing or a certain type of story.
Right.
And then, so then to deny it or say it's changed is almost like denying their own success or denying themselves. And it becomes very, very hard for them to do. And you do see it from time to time. It's an emotional response. And it is very... you don't see it too often, but when you do, you should recognize it for what it means. And often means it's going to be a great short. Last time I think I saw it clearly was around 2010. And I went to some meeting organized by Goldman's, and they were talking about European debt. And I wasn't really that involved in it previously, but I was just listening to it. And this is when spreads were beginning to widen on Italian debt. These managers are going, well, our models say Italian debt's a buy, and our models have always worked for the last 20 years, and we can't buy any more Italian debt. It's so cheap now versus German debt. And when I heard that, I was thinking, I think Italian debt's going to get much cheaper because the models which they built their careers around were telling them to buy, but the world had changed, and that was the last time I really saw it clearly.
I think Bruce Kobner from Caxton has a line where he says, what I look for is a price action that is not confirming consensus. And to your point, the consensus was that it was cheap and that it should be going up. And in the meantime, it's actually going down in terms of the price action. And to that extent, you were mentioning that you're kind of bearish, and one of the, you are kind of, out of all the people that I know, the only guy that's probably more bearish on bonds than me is you. So I'd love to talk about your reasoning for that. And one of the things that I think is interesting is I completely agree with you that everyone seems to be always trying to buy the dip in fixed income, no matter what. Like, it's like, okay, now it's time. And I think they're stuck in this old paradigm where they keep thinking that we're going back to the kind of post-GFC, pre-COVID period of like 1% interest rates. I think you have a much different opinion that interest rates will be much higher for longer. Could you explain to us why you think that?
Yeah, so, I think you have to really get a good idea of it. You have to go back to, why did we have a bond bear market in the sort of 60s and 70s, right? And I think if you, and you need to go to that period before you can really understand where I think we are now. And, when you go back to where that bond bear market came from, it really came from, FDR. And if you don't know FDR, you're not familiar with him, I can really recommend, and it still sits on my desk today, a book called Traitor to His Class. Great title. The Privileged Life and Radical Presidency of FDR. And what that tells you is that, FDR was a very good politician, and he could see where the votes were. And people were tired of depression. They were tired of falling wages. They were tired of falling prices. They were tired of these sort of bank failures and all this stuff. And so he put together this coalition of saying, look, all right, we're going to enforce cartels in business, and we're going to make sure these businesses can't go bust. But the quid pro quo of that is that they raise wages, and we're going to allow prices for everything to rise. So the government's policy was to create inflation, and and people didn't accept it. Normally after wars, you want to buy bonds because when the war spending ends, it's super deflationary. And then what we saw through FDR and the rest of the Western world was no, spending went up, wages went up, and inflation went up. And this was actually a hugely positive policy because it got rid of the Great Depression and created a new world until, and this is what I sort of write about recently. There were, this policy could work as long as the commodity producers didn't say, hey, we need inflation too. So back then, oil price was fixed, gold price was fixed. And as long as you could keep the gold and oil price sort of fixed, this boom could continue forever. But at a certain point, the oil producers and gold producers said, no, hey, we're tired of all this inflation in everything but our products, and they repriced it up. We had the inflationary 60s and 70s. And voters said, we don't like inflation anymore. And Reagan and Thatcher came in with basically disinflationary policies, destroying trade unions, breaking up cartels, free trade, all this, cut tariffs. And consumers loved it. Baby boomers loved it. And that's why we always had this deflationary cycle. And, austerity as well. It was part of that. And what I'm saying now is when I look at the voting coalition that's coming together, if you look at the US, the voting coalition in the US is really all over the place, right? Like, that's where I see it. If we look at the UK, which is similar but not exactly like the US, the next government is almost like certainly going to be a Labour government. And they've got a new voting coalition, mainly of sort of, 40-year-olds and younger who are tired of spending 40, 50% of their income on rent in London and places like that. And so they've got a real powerful mandate to build homes, to get wages up. And what I see is that rising interest rates are actually a part of this policy, in that rising interest rates and rising wages means that house prices sort of fall in real terms but stay up in nominal terms. And for workers, become more and more affordable. So if you're working and getting a wage and seeing wage increases, the sort of a flat housing market over sort of 10 years with wages going up 7, 8, 10% a year on year means that the housing market becomes more and more affordable. And I think that's really where we're going. And that's why I see and why I'm so bearish on bonds is that in the Western world, at least, China might be different, but in the Western world, I see wages rising sort of 10% a year for the next 10 years. And so I sort of see bond yields topping out at sort of 10 to 12%. And when I say that,
you're willing to say that. No, I'm love it that you're willing to say that out loud. Most people won't say that they can't imagine it going above 5.
Oh, bond yields, and then my other view, which I think is we're going to see a baby boom in the next 5 to 10 years.
Okay, why do you tell us about that? Why do you feel that way?
Well, again, it's like I think a lot of people, particularly in finance, finance doesn't really pay people to be creative in their thinking too much, other than doing subprime MBOs and that sort of stuff. They don't really get paid in the long run anyway. No, but we're not, not really paid to be too creative in our thinking. It's what we prefer in finance is to backtest, and for what the past did, last couple of years did, to continue doing for the next 6 to 7 years. That's really what finance loves. They love long bull markets and exactly the same type of stocks, so they don't have to change too much. And they don't really like change. And And if we're talking about demographics, what I see is, again, and I see policies changing to be much more protective of workers, and particularly of sort of blue collar workers. And so we're going to see a sort of a change back to what blue collar workers saw in the sort of 40s, 50s, and 60s. And I think government policy is going to become much more supportive of having families and raising children. So that part, the politics of that fits in the earlier part. The other thing I would say is, if I look at the technology of helping to have babies, so assisted reproductive technology, or IVF as they call it, has improved massively. And what the data is showing us is that if you freeze your eggs, so what the data is showing is that the likelihood of success for IVF is not actually that related to the age of the mother. It's actually related to the age of the embryo or the egg.
Oh, I didn't know that.
Yeah, it's in the post I just did today.
Okay.
So basically, as long as you're using it, so normally if you use like a donor egg or frozen egg, they're almost always going to be taken from a woman under the age of 30, because they don't really take them from women older than that. And what we've seen is that women that use frozen embryos or eggs have virtually the same percentage chance of becoming pregnant up to the age of like 45. Now, if you use a fresh egg or your own egg, which is basically going to be the same age as you, your chances of falling pregnant through IVF fall quite radically from like 35 onwards.
Okay.
And so I think actually women are aware of this now. So again, using UK data, IVF births from frozen eggs has overtaken from fresh eggs in recent years. And what we're seeing is a huge increase in the number of frozen eggs, IVF treatments to freeze eggs. So what I'm trying to say is that I think technology means that the ability for women to have children as they get older in their 30s and 40s is increasing massively. And if we look at the number of eggs getting frozen today, this is giving us a great forward view, 5, 6, 7 years into the future, of future birth rates. And so what I'm seeing is we're at the very end of this transfer of women from having most of their kids in their 20s to women having most of their kids in their 30s and 40s. And, when we're in that transfer window, it looks like the fertility rate is collapsing. And what I think we are now is at that inflection point. And some point in the next 3 to 4 years, I think we're going to start seeing fertility rates increase back to replacement levels quite rapidly.
Well, that's fascinating. So all this kind of leads you to believe that we're going to have a stronger economy. Does this mean that we're going to have a stronger stock market?
Potentially, definitely. What I would say is it's not going to be the same type of stock market that we've had, and it certainly hasn't been for a little while now. What I see and this is mainly in the US, but we're getting mainly in the US at the moment, is I think the best way to understand the shift is that what happened in the 60s and 70s was that the government started to crowd out borrowers. So government borrowing, and the government was borrowing from investors at 12% for 10 years, right? And at that sort of rate, guaranteed return, it was crowding out borrowers into the rest of the market. So basically, the government was sucking in all the debt, right, and crowding out the corporate debt. This was creating problems for corporates, because actually for the US government in some ways did default on this debt when it broke the gold standard. So particularly before that, it had been guaranteed by gold prices. So they defaulted, and then they basically sucked all the air out of the debt markets from corporates and everything else. And so what we saw was sort of like a change in policy where the government went, okay, we have been guaranteeing growth. We have been involved in every part of growth in the US economy. We are not going to do that anymore. We're going to have austerity. We're going to privatize. We're going to get out of lots of different businesses, and we're going to let the corporate sector take over, but we're not going to guarantee any of them. If they go bankrupt, they go bankrupt. If they fail, they fail. If we have unemployment go up, that's not going to be our problem. We are not going to intervene. We are not going to spend our way out of any sort of problems. And so the way I look at it is like from 1980s onwards, the government basically, to defend its own credit standards, really cut loose the corporate sector, right? And so what you saw in any recession, the trade to do in any recession, if you saw it coming, was to short corporate debt or subprime or any sort of debt like that and buy treasuries, right? Because when the government was resisting intervening in the economy, it was creating a deflationary sort of cycle, which would be good for treasuries because they're defending the balance sheet of the government, if that makes sense, by not extending guarantees. And they were letting the corporate sector sort itself out.
Okay.
What's happened since COVID, the way I read it, is government's gone, we are going to guarantee everybody, right? We're going to guarantee everyone. The Fed's done it. You've seen corporate guarantees, you've seen government spend money. They've seen the sort of employment and business payments that are made in the US. And that has become sort of policy. And also, if you look at the politics in the States, neither the Republican Party or the Democrat Party wants to be responsible for a recession because they know it's electoral suicide, right? So they're both there spending aggressively to try and keep growth going and really reach out to the swing voters now, which is the sort of blue collar voters in the Midwest. That is, so the politics has changed. So what I see now is you've had a huge sort of transfer of wealth from the government or public sector to the private sector. So you've seen public debt to GDP soar and stock markets soar. And what you've also seen is corporate debt massively outperform sovereign debt. Does that make sense?
Yeah, completely get it. Like spreads are, everyone keeps wondering, like they say, why are spreads these tight? And what you're saying is that the economy's great and the government's keeps spending and keeping the economy kind of backstopping it all.
Basically, the government is like saying, we are going to just spend and protect everyone until something happens, basically, a bit like in the 60s and 70s. And, given that we look at the oil market, for example, it's still very oversupplied. It's slowly coming under control, but oversupplied, and may remain oversupplied if EV takes off. But if you look at things like that aren't oversupplied, like gold keeps soaring higher and higher. And you're starting to see some of the other precious metals follow. The way I read that is people are going, you know what? The Treasury, which I thought was just me lending money to the US government and the US government taking care of that, and running sort of disinflationary policies. That's not the same government anymore. They're running inflationary policies. And so I don't think treasuries are good. And the other argument I would make is if you look at like the way the Republican Party in particular acts, I got a feeling they would be more willing to default on treasuries than to raise taxes on corporates.
That's hilarious. That makes sense. Can you imagine if that happens?
I could see that happening, believe it or not. And it has happened before. Normally, you default on foreign currency debt is typical,
right?
But Russia back in the day defaulted on ruble debt, and
much to the surprise of everyone, especially long-term capital management.
Correct. And and what was interesting is if you look at, it's always tricky looking at corporate, not so sovereign CDS. But what's interesting is US CDS is sort of hovering around levels seen in 08, 09, which it's not that high, but it's higher than it has been. While if I look at like a Swiss government CDS, is back at all-time lows.
Isn't part of the problem with that though that you actually have to look at the idea that it's actually the cheapest to deliver, and the fact that we have these low coupon bonds actually means that the gain is higher now if they were to default? Like,
Does that really affect the CDS? I don't know.
yeah, it should. I went through the math. It actually, unless I'm wrong and someone can explain to me differently, but if you have, I guess if they truly defaulted, it wouldn't matter, but it does matter if there's just a technical default. So let's imagine there was a technical default on the US government. Okay. And then what they would do was you would actually get to deliver for $100 the cheapest the cheapest bond. So
Oh,
the
I see
fact
what you're
that we
saying.
have like 1% coupons means that your gain on the CDS is going to be higher. So you have to be careful with that. It's not quite like looking at the CDS is not the same as looking at the probability of default.
Fair enough.
Yeah.
Fair enough. I still think the price action in gold for me is
Yeah, no, for sure. And to your point, I think there's times when corporates have actually traded through treasuries, right? Like in the past.
we definitely still used to see in emerging markets, like Petrobras debt used to trade inside Brazilian government debt for a while.
And the way I always think about it is that, Petrobras or, Microsoft can't rewrite the contracts that they've done. They're subject to the rules of the government, whereas the government could theoretically, if they wanted to, rewrite the contract.
Yeah. Yeah. Well, that is very true. And I think personally, what I think is most likely to happen is if the US government starts to get under real financial stress, which is possible. I think the first thing they do is they stop paying any interest on treasuries owned by the Chinese government. So
do you think that's so? Actually, bringing up China, because you're obviously you've devoted a lot of your career to Asia. Do you worry about that? And do you worry about China? Do you think do you subscribe to the theory that China is uninvestable because one day you might get zeroed?
So yeah, it's possible. I mean, the problem it's not like you might not get zero, but a bit like with Russia, you get forced selling, and it becomes impossible to hold. That would be an issue. But what I find really interesting with China is that China went completely the opposite way to the US in that it didn't guarantee any corporate debt. In fact, they would sort of property developers there were thought to have implicit government guarantees. The government went, no, these guys are not guaranteed at all. And in fact, we don't want them to borrow any more money. And those, Evergrande, Country Garden, all those guys went to zero, for example. Yeah.
Yeah.
And the same with the tech guys. So basically said, these guys cheated the system. They need to sort themselves out. So those stocks went down, which is where the uninvestable part comes from, right? But the flip side of that is Chinese government bonds have done much better than US treasuries.
Unbelievable, isn't it? The outperformance?
Well, this is what I was trying to say is that in China, the government has said, no, we are not taking on corporate debt. We're going to protect our own balance sheet and protect the yuan, which has done really well relative to like the yen and other Asian currencies.
Right.
We're going to protect those values by basically cutting the corporate sector loose. Where in the US, you've seen the opposite, where they've sort of taken on a lot of corporate debt liabilities, in my view, implicitly. And so you've got this completely different type of dynamic playing out. And so that's why that market has diverged so much, is that it's policy, and policy is affecting price action, I think, far more than people can accept. And I'll be honest with you, until a few years ago, I also hated looking and talking about politics because it felt like it was outside of my expertise and could change so much. But I've had to accept that politics is such a big part of the world we live in now, that to ignore it is to invite trouble. And so that's sort of why I've spent a lot more time reading books like FDR's biography or the Communist Manifesto to try and get an idea of how the Chinese think and stuff. No, I mean Chinese policy to me makes a lot of sense. But how the US and China deal with each other is tricky, to say the least. Really tricky.
I wanted to kind of pivot here a little bit to Japan. I went for the first time last summer to Japan and I loved it. I'd never been there and I couldn't believe how cheap it is. You've just come back from a trip from Japan and you went and you had some saying that you translated it. It says, go look for yourself. You were like I call myself the macro tourist, but you were truly a macro tourist in that you went and decided to see for yourself how cheap Japan was. Could you tell us about your experience and then also what conclusions you drew from that?
Yeah, 100%. Yeah, so Genchi Genbutsu, which I think is something I use in Toyota for the Toyota production system, which basically means, go see or go to the location and study. So it was really interesting. So I went to Japan. I actually walked this sort of old pilgrimage walk called the Kumano Kodo, which is in Wakayama. It's about 2 hours south of Osaka. Yeah, I had a great time. And, so what was really, and just, for context, I used to live in Japan as like an exchange student at high school and university in the 90s. So back when Japan was expensive, So what was interesting was that if I look at the prices I was paying for things, prices in Japan have definitely gone up in yen terms from what they were. All right. So, when I'm booking a hotel and they go, oh, I want 20,000 yen, or, you go for a nice meal and they want 60, 70,000, 6,000 or 7,000 yen, in yen terms, I'd be thinking, oh, that's expensive, right? That'd be more than I would have used to pay. It's only when I turn it into pound terms and then compare it to what I pay in the UK, I go, wow, that is cheap, right?
And you had some examples of stuff that was just dirt cheap.
Well, going into your convenience store and buying Jim Beam for £7 is unbelievably cheap. And train travel is cheap. And going out was also very cheap. I think the thing that really, I think, what I really think drives that cheapness, partly exchange rate. But, when I was walking around in Osaka, I just saw a job advert for working in retail in a retail store in Osaka. And they were offering 1,100 yen an hour, so like £5.50 an hour. And that really goes to the sort of nub of, the Japanese experience is like, if people don't see pay increases, you aren't going to see price increases, if that makes sense.
Right. And one of your concerns is that hasn't come yet, right? That we've gotten some increases in the price of stuff in yen terms, but the inflation wage hasn't come. But isn't that just a little bit of a lag? And isn't that what the government's pushing hard to push through?
Yeah, I definitely think it is. But, the wages now are definitely lagging things like, because oil is imported. A large chunk of their food is imported. Yeah. So the yen weakness plays directly into that. So, for me, this is where it sort of becomes a little bit counterintuitive, but it makes sense if you think about it for a while, is that for me, if a country is really pro-labor or a government is really pro-labor, they will actually look to be strengthening the currency, not weakening the currency.
Okay.
If that makes sense.
I know, I get it. Yeah.
Yeah. So, for example, Mexico under Almo, and Almo is probably going to be the most popular president of all time in Mexico, elected president. They have 11% interest rates in Mexico. Mexican peso has been strong, and real wages have risen 4 or 5 times over the last 10 years, mainly under Almo. And the big change there is because the peso has been strong. Now, I used to make money showing the peso because, there used to be a saying in the markets, no one ever went bankrupt showing Mexican peso.
I didn't know that.
No, you never knew that. It was true until a few years ago. And if you've been short Mexican peso since 2000, you have lost so much money, you would have gone bankrupt. And this is what I was sort of saying as the world has changed. It's become a politically driven world. But, Almo is definitely a pro-labor type politician. He is out to, boost the living standards of the average punter, Mexico. And what that really means is you need to run a strong currency. And that often means you need to have much higher interest rates, much higher interest rates than what the market expects.
But you
And it
came
makes
to a different conclusion about what you should do in Japan, which I thought was very interesting because here I am thinking Japan is cheap, the currency is dirt cheap. And you went there and said, yeah, the currency is dirt cheap, but I don't think that means you should buy Japan yen. It means this. And what was your trade?
Well, I think, you a bit like in the States, you probably just want to buy equities. I mean, I own PA. I own a couple of banks now in Japan.
Yeah.
Because property is cheap in Japan. It's probably the one country where property is really cheap. And so, it's easy to see a potential cycle there turning. And if I'm right about fertility rates turning, then, Japan, this could be a fantastic generational opportunity for Japanese property, which is now cheaper than the States by quite some way.
I never thought about that. What about shorting JGBs? Has the time finally come?
So the JGB market is a very, I think it's a great trade. I like owning the banks because they give you this sort of short JGB trade implicitly in them. That makes sense.
Yep. No, completely get it. Yep.
Yeah. So, but I think showing JGBs makes a lot of sense. To be honest with you, typically it's not as easy to short JGBs. It's not quite, you don't have the same sort of ETF type market that you do for treasuries.
Well, not only that, the stupid futures contract is so large. You got to be careful.
Yeah, exactly. So what I tend to do is when I wake up in the morning and I'm starting to think about markets, I just look at what JGBs are doing. And if they continue to sell off, which they have been, then I sort of have a lot of confidence in shorting treasuries. That makes sense.
Oh, yeah. Got it. You're using it as an indicator. Listen, Russell, I could talk to you all day, but unfortunately we have to cut it to an end there. Why don't you tell people about your great Substack? And I don't know, are you on Twitter these days? Like, I don't go on Twitter, so I don't even know. Or are you just focusing on Substack?
Just on Substack. I probably should.
Nah, you probably shouldn't. It's all right. Okay, so what is the Substack? How can people sign up? And you don't need to pay. Like, you can go and just check it out, right? And sign up and you get the occasional free one.
Look, most of it is free.
Right.
I'll be honest with you. So it's www.russell-clark.com. That's Russell with 2 S's, 2 L's, Clark with no E. And that's where I just sort of lay out my thoughts. I do about 2 or 3 posts a week. Some of them are serious, some are not so serious, but they tend to all be market related. So have a look there.
Great. Well, thank you very much for joining us and sharing your opinions.
Thanks for having me.